What's up everyone, it's Scotty with Money Investing. In this video, wanted to break down Bill Ackman's short on the US Treasuries, what the thesis really is, and also go over some of the other analysis, technical analysis, of course, go over what I personally also believe with respect to interest rates and why I am actually on the other side of the trade, but we both have different time frames when it comes to those trades as well. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything is going to be included, as well as the members only private videos, which I will be posting a lot of them this weekend, and the intrinsic value spreadsheet with a full list of stocks that we're tracking and keeping watch on, and of course putting our fair values on that spreadsheet as well. So all that is going to be included with the link down below. Would love to have you on board. So this right here is the CME Fed watch tool, as we already know, but we're going to come back to this. First of all, I want to break down exactly what Bill Ackman tweeted not too long ago. He pretty much mentioned that I've been surprised how low the US long-term rates have remained in light of structural changes that are likely to lead to higher levels of long-term inflation, including deglobalization, higher defense costs, the energy transition, growing entitlements, and the greater bargaining power of workers. And as a result, I would be very surprised if we don't find ourselves in a world with persistent 3% inflation. And of course, right now the headline ticked back higher to over 3.2%, right? So we got the inflation numbers yesterday. Headline ticked back higher, 3.2, and core is still sitting at 4.7%. And this right here is specifically things that we have talked about on the channel. I have explicitly mentioned the supply-demand imbalance with respect to treasuries and the auctions that we're seeing at the moment. In fact, 6 hours ago, Reuters even reported that the demand for long-term treasuries has been very weak, and for those reasons, we're seeing the yields move back higher. And he also goes on by saying, and I quote, "From a supply-demand perspective, long-term treasuries also look overbought with $32 trillion of debt and large deficits as far as the eye can see, and higher refi rates and increasing supply of treasuries is assured. When you couple new issuances with QT, it is hard to imagine how the market absorbs such a large increase in supply without materially higher rates." So what he's saying is, with quantitative tightening that the Federal Reserve is doing, with all the balance sheet roll-off with their treasuries that they already have, and the new issuances, there is absolutely a certainty that the market is going to have a supply and demand imbalance, and it's very difficult to imagine how the market's going to absorb all that increased supply in the market when it comes to Treasury securities. He also goes on by saying that I've also been puzzled as to why the US Treasury hasn't been financing our government in the longer part of the curve in light of materially lower long-term rates. This does not look like prudent term management in my opinion. So basically what he's saying is the US Treasury is issuing a lot of short-term, short end of the curve bonds instead of the longer part of the curve, which does have lower interest rates. And then consider China's and other countries' desire to decouple financially from the US, YCC ending in Japan, increasing the relative appeal of yen bonds versus treasuries for the largest foreign owner of treasuries, and growing concerns about the U.S. governance, fiscal responsibility, and political divisiveness recently referred in Fitch's downgrade. And finally, we also know that Japan also is more flexible with ending their sort of predetermined interest rates. And of course, they are starting to become more flexible. Yen bonds, again, increasing the relative appeal of yen bonds versus treasuries, the largest foreign owner of treasuries as well. And finally, so the long-term inflation is 3% instead of 2% and history holds, then we could see the 30-year treasury yield equals 3% plus 0.5, the real rates plus 2% term premium or 5.5%. And it can happen soon. And there are many times in history where the bond market reprices the long end of the curve in a matter of weeks. And this seems like one of those times as well. So he is expecting the 30-year to get up to over 5.5%. And he says that's why we are short in size the 30-year treasuries, first as a hedge on the impact of higher long-term rates on stocks, and second because we believe it is high probability standalone bet. There are a few macro investments that still offer reasonably probable asymmetric payoffs, and this is one of them. And the best hedges are the ones that you definitely have to invest anyway. You don't have to see it as a hedge, but this fits the bill. And I also think we need the hedge as well. So that's really what he's talking about in this sort of entire Twitter post, is that he is short 30-year treasuries, and he expects the 30-year treasury yields to get up to over 5.5%. And of course, if yields go higher, prices go down. That's why he's taking that short bet. He is, he's got a conviction in this potential scenario because of the supply and demand imbalance and the issuances of new auction on the shorter end of the curve. So expecting there will be repricing on the long end of that curve as well, coupled with QT expecting rates to be higher. So in my opinion, I think there is very, very high probability that this ends up playing out. And the reason for that is because we've talked about the issuances, we've talked about the supply and demand imbalance, we've talked about the fact that the US fiscal policy is, unfortunately, as mismanaged as it is, there is going to be a time where yields continue to go higher because of the US debt perceived as being more and more risky, considering that there is a lot of fiscal deficits, the debt continues to grow, and the Federal Reserve and of course the fiscal Treasury Department needs to borrow more money in order to continue to finance their operations. So if we come over to the Treasury charts here, I'm going to reload this just so we have a good understanding. So right now, of course, we do have the 10-year back over 4%, trading at just a little bit under 4.1. But of course, we do have a lot of other ones, including the 6-month trading at 5.5, 3-month trading 5.4.5, 1-year trading 5.3. The 30-year is trading at 4.485, right? So it has been pushing higher, and it is still moving in that direction as bond prices continue to come down. TLT, TMS, some of these have continued to struggle because of this supply-demand imbalance and, of course, the issuances that we're seeing. Of course, Ray Dalio also mentioned the U.S. is facing a big cycle debt crisis and warns things are going to get worse for the economy. We broke down exactly what he had to say, his entire report, his paper on LinkedIn. I did a separate video on that as well. And this right here is literally from 6 hours ago. The U.S. 30-year Treasury auction signals weak demand to wrap up week of big sales. So week of big sales indicates markets struggling to absorb deals, and U.S. 30-year yield jumps higher as auction trumps inflation data as well. This is literally from today, from 6 hours ago. So we need to be careful. We need to be cautious here, because if the U.S. 30-year yield continues to push higher, even the 10-year or some shorter end of the curves continue to push higher, well, that's going to put pressure on equity prices, as we already know, because it's all a game of liquidity and, of course, competing liquidity, meaning if yields are offered 4.5, 5, 5.5, closer to 6%, then, of course, equity premiums are going to come down, and equities relative to bonds are going to start to become less and less attractive from a investment perspective. So pushing higher, 4.2.5%. Of course, the high is going to be up as high as 4.4. If you do break out over that level, then of course 5.5% is very much a possibility for the 30-year and even for the shorter end of that curve as well to continue to push higher. So let me know your thoughts down in the comment section below. I do want to make that last point that even though this is more on a short-term basis, over the long term, I do still expect the yields to come down, the interest rates to get cut as we go through this normalization period, because the supply and demand imbalance is temporary. It's not a permanent situation, because the fiscal department, the fiscal policy, the Treasury Department was very much behind on these debt issuances because of the supply not being there, because of the debt ceiling not being raised or suspended in time. But eventually I do see a more normalized period where starting next year, I do expect the yields to roll over and interest rates to start getting cut from the Federal Reserve. As you can already see, the market's pricing in 5 to 6 cuts going into 2024. And that's when I do expect the bond market, the bond prices to start pushing higher once again and the yields to roll over. But in the short to medium term, I think Bill Ackman could actually come out ahead, considering that there is very weak demand because of the increased supply with respect to these treasuries. So I hope you guys enjoyed this video and a complete update on the bond market, and of course a little bit of the analysis on the supply demand here. Make sure that you drop a like, subscribe, Discord, Patreon, link's going to be down below if you're interested in joining us. Get access to all the buying alerts, options alerts, trade ideas, everything's going to be included, as well as the members only private videos and the intrinsic value spreadsheets. As always, happy investing. I'll see you all in the next video.